Good afternoon, everyone. Welcome to our first quarter 2024 Market Insights webinar. Our goal here is consistent with past webinars. We'd like to share with you our thoughts and summaries of what happened during the previous quarter, as well as provide everyone some themes to watch for the remaining 9 months of the year. Now, before jumping into the content, the usual housekeeping items. We are here to answer questions that are on your mind. If our comments do not address and answer the questions that are on your mind, please go ahead and submit a question using the Q&A feature. We have had some questions that came in ahead of time. We will address those first. To the extent we have time remaining in today's hour, we will also answer any questions that you'd submit. Secondly, this webinar, like previous webinars, is being recorded and will be uploaded to our YouTube channel. So if you are so moved to rewatch or share with your colleagues or fellow committee members, please go ahead and share via our YouTube channel. Now, for introductions, my name is Greg Leonberger. I will be hosting today's webinar and also covering the U.S. economy. Frank Valli will lead us through fixed income, and then Catherine Hillier and David Hernandez will cover U.S. equities and non-U.S. equities, respectively. We will then transition to the alternatives portion of this afternoon's webinar. Evan Fraser will discuss hedge funds. One of our newest team members, Michael Carlton, will cover real assets, which consists of real estate and infrastructure. Amy Miller will lead us through private equity, and Shad Schaefer will take us home with private credit. We like to lead with the U.S. economy, and one of the primary themes going into the year was the Fed pivot, particularly how was the Fed going to reduce interest rates in terms of magnitude and frequency. Their decisions would largely be based upon the trajectory of inflation, secondarily, the labor market, and thirdly, overall economic growth. First, inflation. There's a report that came out today, the newest measure of PCE inflation, which we unfortunately could not build into today's presentation since it came out today. But the report today was for the latest measure of PCE inflation. It was 3.4%, which mirrors the CPI report earlier this year of 3.5%. Notably, both these figures are still above the Fed's long-term target of 2%, and is one of the reasons why the Federal Reserve has moved from expectations of cutting rates 5 to 6 times this year to at most 2 times this year. We will revisit this theme often throughout the different asset classes, but certainly this shift in narrative towards a higher for longer interest rate environment and less Fed cuts has had and will continue to have an impact on markets. As I mentioned, the labor market is also part of this consideration. The March jobs report came in hotter than expected, with 300,000 jobs created, unemployment rate ticking down to 3.8%. Now, while in a labor market only vacuum, those are good numbers. They represent still a lot of upward pressure in terms of wages within the job market, and that can also contribute to inflation. So again, we need to see a bit of a slower job market as well as lower inflation numbers for the Federal Reserve to really resume talks of approaching more than 2 cuts. So this chart here mentions or describes the expected number of cuts this year. Again, at most we're looking at 2. A month or 2 ago, expectations were for a cut in June. Now that has shifted to September as the first likely cut from the Federal Reserve. Again, still contingent upon inflation data and other data points. Another report which came out today was GDP. The first quarter GDP came in at 1.6%, below expectations of 2.4%. One of the primary reasons for this was that consumer spending dropped from an expected 3% number to a 2.5% growth. The good news is that GDP stays positive. We've heard talk and worries about a recession. However, as long as GDP stays positive, we will not be in a recession. The federal funds rate still likely to come down a bit this year, but again, that hinges entirely on the Federal Reserve and the decision to cut interest rates. The unemployment rate is likely to stay steady, and inflation should drop further in the next couple of years. So overall, economic growth remains positive. However, the report this morning was a bit disappointing. As we head now to the asset class discussion, we like to start with the fixed income. That's the most easily observable asset class in relation to Fed policy. So Frank, I'll hand it to you. Certainly a little bit of a challenging first quarter for fixed income, but I know overall you're still pretty positive on the asset class. All yours.
Thanks, Greg. So as Greg mentioned, it was a rough start to the year for fixed income. In the fourth quarter of last year, we saw a lot of gains as people started to bake in the idea that there was going to be this Fed pivot. However, in the first quarter of this year, we saw those expectations paired, and most of the rate-sensitive sectors had negative total returns. Some of the less rate sensitive sectors like high yield, bank loans, some areas in the structured products, those did exhibit some positive excess returns. So across the curve, we've seen treasury rates increase all the way from the very short end to the long end over the first quarter. This was on the back of strong economic numbers. As Greg mentioned, there was some good job growth and also some persistently sticky inflation. The treasury curve remains inverted. The current inversion is longer than any in U.S. history. At the end of the quarter, it sat at 635 days, and the market is starting to adapt to the narrative of higher rates for longer. That higher rates for longer means the expectations for a rate cut in 2024 have fallen. Coming into the year was probably one of the best bets you could have made, and that was to take the under on the amount of cuts priced into the market. At the end of December, the market was expecting 6.3 cuts through 2024. That was paired to less than 3 at the end of the quarter, and now sits at about 2. This is in line with what the Fed had always projected for cuts in 2024, and that was for 2 cuts. Well, what's the good news? So the good news is bonds are still back. Higher base rates are leading to higher all-in yields. Most of the sectors, or all of the sectors, have higher than average yields. The bad news is spreads are still tight. Most of the spread markets are trading inside of historical averages. This is because the demand for credit is strong and the supplies have really been limited. But there may also be another reason why credit spreads are so tight, and that's the strong fundamental outlook. Defaults have been historically low. They have been creeping up a little bit, but we're still only to average. Looking ahead, defaults are still expected to be around historical averages. When we examine the whole credit market and look beyond just the high yield market, the investment grade market has seen less downgrades to high yield than there have been upgrades from high yield to investment grade. All of that says that it's positive for fixed income fundamentals. So all in all, the fixed income outlook is strong. This analytic here really shows a range of scenarios of what could be seen in the fixed income markets. If nothing really happens over the year, you should expect to get a return similar to the starting yield. So the starting yield on the ag is 4.9% at the end of the first quarter. If you do see either spreads move wider in the case of recession or treasury yields continue to move higher, there are some scenarios where you could see a negative total return, but under most spread and rate and treasury rate movements, you'll see a positive total return. So just to wrap up on fixed income to conclude, what are the opportunities? The good news is bonds are still back. Higher starting yields should provide positive returns for fixed income. The investment grade corporate market is very healthy. There's a good technical providing some support. There's also some strong fundamentals, and that also provides some additional income into a portfolio. What are the risks that are out there? The primary risk is the Fed doesn't act as fast as expected, and that could push interest rates higher, which would be bad for fixed income. The second thing would be an economic downturn. Most spread markets are priced very tightly. If there is some sort of an economic hiccup, you could see spreads widen fairly significantly. And then the final risk in the market is the wild cards that exist. 2024 is going to be an election year. There's usually no shortage of drama in those years, which could lead to increased volatility.
Anyone who's been listening to these webinars and been reading any of the letters or previews we put out, well, this should all sound familiar. Yields are high, income is high, fundamentals are in a good spot. Credit markets are healthy. However, a lot of this does hinge on the Federal Reserve and what they do or don't do, and that will likely have an impact on fixed income for the rest of the year. So that's fixed income. Let's move to U.S. equities now. And Catherine, overall, is a pretty good story in the first quarter. Certainly some divergence amongst indices, but everything was positive to start the year. Take us through a little bit more of what you saw from a performance perspectives and what you're watching for in the coming months.
Yeah, thanks, Greg. So to start the quarter, the performance for U.S. equities was actually quite mixed, as narrow market leadership carried over into 2024. But as the quarter progressed, resilient earnings growth and positive economic data helped increase market breadth. So as a result, and as Greg mentioned, all major domestic equity indices ended March in positive territory for the year, and the S&P 500 and Russell 2000 indices gained 10.6 and 5.2% respectively. While growth equities did continue to show strength early on in the year, Driven by a familiar story of strong performance from the technology-related companies, value equities did outperform in March across the market cap spectrum. But two unique dynamics did unfold in the quarter. One, the S&P 500 achieved multiple all-time highs in just the span of the first 3 months of the year, posting its strongest start to the year since before the pandemic. And second, narrow market leadership emerged in small cap equities. This is a unique dynamic for this space, as just two companies contributed an outsized portion of returns for the small cap equity indices. Many have probably already heard of these companies, but just in case, they are Supermicro and MicroStrategy. These companies hold the largest weight in the Russell 2000 Growth Index, which returned 7.6% in the first quarter. But without these companies, it would have returned just 3.9%, so a pretty drastic difference. And this was a considerable headwind for small cap active managers in the quarter. So part of what contributed to the strength in equity markets was signs of increased market breadth, which is evident in sector level performance. All of the sectors in the index advanced in March, and most advanced for the quarter, with the lone exception being the real estate sector, but that sector did also post positive returns in March. Leadership was also diversified, as growth-oriented sectors like communication services and information technology, which holds several of those Magnificent Seven companies, led alongside the more value-oriented sectors we're used to, like energy and financials. Another sign that investors may be starting to expand their focus across the market is the S&P 500 Equal Weighted Index also reached an all-time high in March. As you can see here, though, the market cap weighted index does continue to lead in 2024 with increased concentration in the top 10 constituents in the index. Robust earnings growth for select Magnificent Seven companies continue to support the performance of these stocks, as the group contributed almost 37% of the total S&P 500 return in the first quarter. But this has fallen from the 60% those stocks contributed in 2023. And to preview the next quarter a little bit, this strength among the mega cap technology related companies did hit a bit of a snag in April, as the so-called tech rep helped drive the S&P 500 lower in recent weeks. Now, going back to the first quarter, how well did the Magnificent Seven truly perform on a company basis? Well, the results are quite mixed, another notable change from 2023. Tesla and Apple stumbled in the first quarter, as Nvidia and Meta emerged as the early winners of 2024. Something that has been heavily discussed is valuations among this group of companies, with some investors asking, are these companies now priced for perfection, and can they really continue to produce strong enough earnings growth to support these valuations? Marquette has considered this one of the risks to U.S. equity markets for a few quarters now, and this slide may indicate that among some of these companies, we are starting to see signs of weakness. Tesla and Apple are the clear culprits to point to here, but Nvidia did actually also enter a technical recession in April, despite recent strong earnings announcements in the last couple quarters, as it got caught up in that so-called tech wreck I mentioned previously. So there could be some signs that valuation concerns are real. As I mentioned, earnings growth is part of what has helped propel these companies higher since the start of 2023. On this slide, we see the earnings growth differential between the Magnificent Seven and the rest of the companies in the S&P 500. Now, this is expected to peak in the first half of this year as earnings growth slows for this group of companies as a whole. So this may be a positive sign for the rest of the market and may help support further market breadth. And combined with what we showed on the prior slide, it may be increasingly more important to look at these companies individually and not as a group as we have done in recent quarters. It may also be worth mentioning that as this market breadth increases, relative performance for the median active manager does also tend to improve, which may be a positive sign for active managers moving forward. And something I found interesting in the first quarter was the rebound in performance for actively managed large cap growth strategies, with almost 70% of mutual fund managers outperforming. While this is a very short period of time, and I acknowledge that, it can be a sign that the market backdrop is starting to possibly shift for active managers. And as we've already mentioned through Greg and Frank's comments, a common theme in markets for several quarters has been this uncertainty. And this uncertainty has led to extreme moves around Fed announcement and economic data prints. In a higher for longer interest rate environment, as we mentioned on previous webinars, small caps have proven more susceptible as these companies tend to have higher debt burdens relative to their larger counterparts. And this has been evident as rates have moved higher and this asset class has underperformed. But if you remember back to the last couple months of 2023, small cap equities rebounded sharply. The perception of multiple interest rate cuts in 2024 after the Fed had held rates steady at their last two meetings of the year was viewed very positively for small caps. Unfortunately for equity markets, the outlook for rate cuts, as we've mentioned already, has reversed course quite dramatically. And although the next Fed meeting isn't until next week, April is still seeing notable volatility following a stronger than expected inflation print. The idea of this persistent inflation has weighed on equity markets as multiple Fed members have spoken throughout April, damaging the outlook for interest rate cuts. This again sent markets lower in April, and small caps again reacted more sharply. So something we can likely continue to expect is this volatility as the economic backdrop remains uncertain. So I've included this slide for several quarters now because the story really hasn't changed much. There's been this continued strength among large cap equities, which has driven historically attractive relative valuations for small caps. But this hasn't been enough for the dynamic to shift in favor of small cap equities just yet. It will likely be pretty important for small caps to show strong earnings growth in 2024 after a pretty lackluster 2023 to help propel this asset class moving forward. And to look at the opportunities and risks, we've touched on some of these throughout the presentation, and largely these do remain unchanged from previous webinars. Small caps continue to appear attractive, as I just mentioned. Earnings growth is going to be critical for continued strength in the market as well as increased market breadth. But some of those risks do still exist. The concentration risks with the Magnificent Seven, as well as the economic uncertainty risks that we see in the market today too. One thing we did add is the potential opportunity for quality and profitability factors moving forward. As we settle into this higher for longer, hopefully more normalized potentially interest rate environment, these two factors, quality and profitability, may prove positive or may prove to support performance moving forward, and that could be beneficial for active management.
Thanks, Catherine. I think one of the things to really focus on, and again, this is really the only sustainable mechanism for long-term positive equity markets is earnings. And as we start to perhaps see a dip in the Mag 7, watching the rest of the constituents of all the indices across the U.S. equity market will really be telling about what to expect longer term out of the equity markets. Thank you for going through that. Now let's cover non-U.S. equities here. And David, similar theme to U.S. equities in that indices were positive over the course of the first quarter, albeit slightly lower magnitude than U.S. equities. But digging deeper into that, tell us what you see from a regional perspective and other driving forces in the market.
Yeah, well, 2023, we'll go back a year real quick. It was a strong calendar year for public equities with most global indices producing double-digit returns. And that positive momentum really carried into the first quarter of 2024. You look at the performance table, you see positive numbers across the board. Some things that stand out to me is you have developed markets continuing to beat out emerging markets. You have large cap stocks that are continuing to beat small cap stocks. On an individual country basis, you have the United States, you have Japan. They've continued their momentum from 2023, continue to be leaders on the global equity landscape. And then China, some of that negative momentum has carried forward. And that continues to be a laggard here this year. Now, in some upcoming charts, I'm going to talk about Japan and China. But first, I wanted to start with a recent trend that really took a lot of experts off guard here in 2024. And so after a negative fourth quarter, the US dollar rallied here in the first quarter. And this rally really was a product of a significant shift in US interest rate expectations that have already been discussed. So the essential idea is that the higher for longer environment is lasting much longer than anyone would have anticipated or most would have anticipated. And as a result, for US investors, currencies detracted 4.2% from developed equities and 2.1% from emerging markets in the first quarter. If we think about things going forward, we think that the dollar can continue to strengthen from here, and that would present a short-term headwind for non-U.S. equities. Now, a key reason why the dollar can strengthen further is the potential divergence in monetary policy between the Fed and other central banks in the world. For example, as of yesterday, April 24th, the market placed an 85% probability that the European Central Bank would begin cutting this June. the market places a 15% probability that the Fed will be cutting this June. And so these odds have really shifted the last several months, with it being much more likely that the ECB is going to cut sooner than the Fed. And if we think about reasons why that is, I think you can boil it down to two key points. So firstly, U.S. economic environment is relatively strong compared to Europe. You've seen growth numbers usually north of 2%. In Europe, it's essentially flat. Secondly, the last 6 months, we've seen European inflation move lower, while inflation in the United States has been much more stubborn. Reminds me of my pet dog when I'm trying to give it a bath. He just won't budge. That's kind of what inflation's been like in the United States. So with significantly slower growth in Europe and lower pricing trends, that means it's more likely for Europe to cut rates sooner and probably more often here in 2024. And all else being equal, that's going to be supportive of a strong dollar, and that's a potential headwind for non-U.S. equities. Now, while Europe has seen inflation move downward the last several quarters, Japan has actually seen inflation move upward. And for that country, that's actually a good thing. So for decades, Japan has been dealing with deflationary environment. However, the most recent round of annual wage negotiations was very favorable. So they have wage growth expectations north of 5%. That, coupled with inflation north of 2%, that really gave confidence to the Bank of Japan, or the BOJ, to end their negative interest rate policy. And that's led to investors being optimistic that we can see more stable and normal pricing environment there in Japan. Investors are also optimistic about the possibility for broad-based improvement in company fundamentals for Japan. So for the last 15 plus years, Japanese companies have really underwhelmed as it relates to return to shareholders. Now, current measures are still well below global peers, but recent Japanese reforms have investors optimistic about future returns on equity potential. So in Japan, you have better stability from an inflation and environment perspective. You also have optimism around potential improvements on shareholder return. You also have low valuations compared to a lot of the rest of the globe. And these three things have really shifted investor attention and focus on Japan. And as a result, last year, 2023, Japanese equities were up 20% for that year, and they're up 11% in the first quarter of 2024. And in our recent conversations with active managers, this country is still expected to be a key source of investment opportunity and potential to generate return for the rest of the year. Now, I mentioned low valuations in Japan. Another Asian country also has low valuations, and that's China. But we aren't hearing as much on the optimistic front on this country. You have an economic environment that's still very muddy. You have property sector that still remains challenged. And as a result, you've seen China produce 3 straight calendar years of double-digit negative returns. If you look at the trailing 3-year analyzed return for China, it's down 18.9%, which is pretty significant. As a point of comparison, you can take another country in Asia, India. You've seen very opposite performance. So India, over the trailing 3-year basis, is up 12.3%. And this difference in performance between these two countries has resulted in an interesting change in the EM landscape. So the MSCI EM index the weight to China peaked in 2020. At the end of that year, it was 39%. At the end of the first quarter, it's 25%. So it's come down pretty considerably. And then in comparison, India's weight to the MSCI EM index China has doubled since 2020 from 9% to 18%. So for most investors, their direct China exposure has come down pretty considerably over the last 3 years. And to put this in a broader context, so not just talking about emerging markets, but now let's look at the global equity universe. China's only 2.3% of the MSCI All Country Index. And that's the 7th largest country exposure in that index after the US, Japan, UK, France, and a couple of others. That's come down. They were the 3rd largest at the end of 2020. Additionally, there are 3 U.S. companies that independently have a larger weight in the ACWI index. So a typical investor has more direct exposure to Microsoft than entire direct exposure to China. Some interesting changes that we've noticed over the last year or so. So that is our slides for non-U.S. equities. I want to wrap things up by looking at some of the risk and opportunities. We talked about China. There are some concerns there from an economic perspective, from a property sector perspective. Valuations are cheap, but we need some catalysts to help unlock some of those valuation return potential. Talked about Japan being an area of focus, a lot of positive momentum there and opportunities for investments there. We also talked about the expected divergence in monetary policy between the ECB and Fed and how that's likely going to lead to a strong dollar, which creates a potential headwind for non-U.S. equities.
Thanks, David. And as I see it and look through everything you just presented, I think the two biggest ones to follow carefully over the next quarter or two are the divergence in interest rates and interest rate policies in the U.S. and ECB. That's going to be a headwind, most likely. And then the ongoing opportunities that we're seeing in Japan and the mounting momentum and good stories coming out of Japan for investment opportunities. So those will kind of work in opposite directions, most likely, but two themes which bear watching quite a bit. Well, we've wrapped up the traditional portion of the webinar, and we'll move on to hedge funds here. And hedge funds to kind of open up the alternative section. Evan, hedge funds, the story of hedge funds has changed a bit over the last couple of years, and the hedge funds are again delivering on the expectation of diversification and principal protection during times of market stress. So, Evan, again, a little bit what you saw in the first quarter, and then what you're watching for the rest of the year.
Yeah, thanks, Greg. You're absolutely right. It's funny, our fixed income team has spent pretty much all of the last 12 or 15 months saying that bonds are back. I've probably heard Frank say it about 1,000 times at this point. But I think given recent performance on the hedge fund side, it might be fair to say that hedge funds are back as well. So as you can see here, strong returns from last year continued into 2024. With pretty much every major strategy type notching gains in the first quarter. So you'll see that the HFRI macro index was up nearly 7% in the period. That's a really phenomenal number. We'll talk about sort of the drivers of that performance in a couple slides here. But equity-oriented strategies were also strong. 1Q was a great quarter for long-short alpha generation in particular, as we'll see in a minute. And then option strategies were up there as well, with the put right index there up about 5% for the quarter. Not too surprising, kind of given the higher betas of those types of strategies. So a really good period, I would say, except for merger arb. You'll recall those strategies finished last year on a high note, but have since moved somewhat sideways, thanks to continued uncertainty around the regulatory and deal-making landscapes, as well as recent Fed rhetoric surrounding the near-term outlook for interest rates. So that's one area of relative weakness, but everything else seems to be chugging along rather nicely. So I mentioned that long-short alpha was strong to start the year. So strong, in fact, that 1Q marked the best first quarter for long-short alpha since 2010, which is when Morgan Stanley started tracking that data. And much of this is thanks to that greater market breadth, at least relative to levels that we saw last year. So this dispersion in performance between individual stocks has led to positive contributions from both sides of hedge fund books to start the year. And this has really helped in terms of relative hedge fund performance, that is relative to the broad equity market. So typically when equity markets are up 5% or more in any given quarter, as they were in the first quarter of this year, hedge funds capture anywhere from 60 to 65% of that gain. But again, thanks to that strong stock picking and positive long-short spread that we saw last quarter, that figure was closer to 75%. So certainly a fantastic start to the year for equity-oriented hedge funds on both an absolute and relative basis. Okay, so again, macro, you'll recall, was up around 7%. In 1Q, that is the best quarterly number for that index, the HFRI Global Macro Index, in over 2 decades. So what was happening there? Well, a lot of this performance has to do with commodity price movements during the first few months of the year. So loyal readers of Marquette Research will remember we put out a chart of the week earlier this month on the price of cocoa, which has gone parabolic in recent time. They've actually climbed so high, those prices, that we had to create a secondary axis here on the right-hand side just to make everything fit on this the same chart. But you can see here too that other commodities like gold, copper, oil, etc., have all seen their prices move materially higher in 1Q as well. And this is important because a lot of these macro managers either have long commodity positions, or they're able to trade higher levels of volatility within commodities markets in a prudent and alpha generative way. So that's one reason for strong performance from macro managers. Another would be what Frank discussed earlier, sort of those changes around interest rate expectations. So, you'll recall that at the end of 23, investors expected monetary easing as soon as this spring, with a total of 5 to 6 rate cuts for the full calendar year of 24. But fast forward to now, we might not even get a rate cut this year. But again, those expectations at the end of last year were based on broad investor sentiment. A lot of macro managers, may have been a little bit more discerning than the market to start the year, and were able to trade around the idea that rates were going to stay higher for longer. That ultimately proved beneficial to overall performance. So certainly nice to see a great start to the year for global macro, especially after a somewhat challenged 2023 for that space. Yeah, so I wanted to spend a little bit more time on put right performance and outlook, since we here at Marquette utilize those types of strategies fairly extensively. So as I mentioned, 1Q was another strong quarter for put right, coming on the heels of a strong 2023. But I do think it's interesting to kind of take a look at where those returns have been coming from. So as we've discussed on previous webinars, the yields on the assets that are used to collateralize the short option positions within those portfolios are now much more attractive than they were, say, a couple of years ago. So much so that the returns from the collateral pools have made up roughly 1/3 of overall put right returns in recent time. And that's up from somewhere around 10% of overall returns from 2017 to 2022. And so there's quite a reversal there. And thank goodness for that reversal, because implied volatility, as we can see here, is currently very low, based on kind of current and historical VIX futures curves. And this is important because the other component of put right returns is, of course, the premiums that you receive from writing these options, the prices of which are functions of implied volatility. And to that point, option premiums between COVID and when the Fed started hiking rates were roughly 2.5 times higher than they've been since the start of this rate hiking cycle. So, of course, we've seen a bit of an uptick in market volatility in April. So option premiums may be trending back up at this point, but I think it's fair to say that the collateral yields will continue to play a meaningful role in terms of put right returns going forward, given current expectations around near-term interest rate levels. So just quickly on hedge fund positioning before we turn to risks and opportunities. So hedge funds ended the first quarter with gross and net exposure levels of around 200% and 55% respectively. I would say that's quite high. So on the gross side, current exposures sit in the 99th percentile of levels dating back to 2010. Now, most of this is being driven by the long side of the book. However, short leverage is elevated as well relative to historical levels. And then in terms of where managers are currently seeing the most opportunity, at least on the equity side, so Europe has been actually an area of focus for a lot of funds. So according to Morgan Stanley, again, U.S.-based hedge funds have been adding to European exposures for the last 5 months at this point. And then in terms of specific sectors that are areas of focus, so semis continue to be attractive to a lot of funds, very high levels of net exposure there. But then overall exposures to the TMT space have actually been coming down over the last couple of quarters. So non-Mag 7 TMT shorts have actually been added pretty extensively since last year, whereas flows to those 7 stocks, those Mag 7 stocks, have actually remained relatively flat. So that's a bit on current hedge fund positioning and exposure levels. So let's bring it all home here and talk risks and opportunities. We'll hit the bad stuff first, kind of get that out of the way. So I just talked about kind of higher levels of leverage and exposure. That's not necessarily a risk. But if stock picking turns bad, or we get a market downturn, or a more narrow market like we saw last year, those exposure levels could work against funds. I talked earlier about merger arb strategies. facing a lot of regulatory and deal-making uncertainty. I don't think that's going away anytime soon. We've talked in the past about pod shops. I'm sure a lot of you who are listening have heard about this kind of war for talent that's going on. The dollar amounts that are getting thrown around make me wonder if it's too late to go, be a PM for one of these shops. Kidding, obviously. But all of this personnel churn means that a lot of firms right now may be a little bit more unstable from a resources and team perspective, and likely will be going forward as well. And then the last risk that we have here actually ties into one of the opportunities that we have, which is the potential for fundamental managers to struggle in sort of macro-driven markets. But for global macro managers, I mean, they've got macro right in the name, right? So, and we saw earlier how a lot of them were able to take advantage of opportunities related to, say, commodities or rates. So a lot of those funds could continue to benefit if we see more macro-driven, macro-related market moves. We talked about higher levels of dispersion being good for equity managers specifically, whether that's on the long short or market neutral side. Higher interest rates, obviously, again, they boost the returns of VRP strategies via those higher yields on the collateral pools. And then I always like to kind of wrap things up with sort of the value proposition for hedge funds broadly. That is diversification, capital preservation, alpha orientation, flexible exposures, flexible mandates. Greg, you mentioned so far this year, funds have largely been able to deliver on those value propositions. And I certainly hope that continues because that makes my job a lot easier. So with that, I will turn it back over to you, Greg.
Thanks, Evan. And the hedge fund section is always really a broad summary of everything we're watching in the markets, from more dispersion in the markets to earnings to higher for longer, sometimes geopolitics figure into it. And again, all in the name of continuing to achieve their goal of capital preservation, diversification. And this year's no different. There's a lot of variables out there, and the hedge funds, which can effectively navigate those dynamics, are probably poised to deliver the best returns. Thanks, Evan, for all those comments. Let's move now on to real assets. And I don't want to put any pressure on him making his webinar debut, but Michael Carlton is going to cover real estate and infrastructure. Michael, the floor is yours.
Thanks, Greg. And we'll start with real estate here. So 2023 certainly proved to be a challenging year for private real estate. But as mentioned in the last few webinars, much of that dislocation has actually been driven by capital markets and regional bank retrenchment. So today I'll touch on a few broad themes and explain why outside of the office sector, fundamentals remain healthy and the outlook is positive. Before looking ahead, I'll briefly touch on 2023 performance. And as a reminder here, the performance data is as of December, since real estate is reported on a lagged basis. Private real estate, represented by the Odyssey, contracted by 4.8% in the fourth quarter, bringing full year performance down to negative 12%. On the other hand, the positive momentum for public real estate in the fourth quarter continued, as seen by the NAREIT's positive 18% return, which effectively erased the negative third quarter performance and brought the index to positive 11.4% for the year. We also recently received preliminary data from NACRE for Q1 with the expectation of negative 2.5%, which continues private real estate's journey to finding its bottom. And finally, I'll touch quickly on property types. Hotels led the way with an 8.4% performance for 2023. And to no one's surprise, office brought up the rear with negative 12.9%. Now, importantly, private cap rates have historically lagged publics, which is a key driver behind outperformance in 2023, as publics took their licks over the course of 2022. We expect private pricing to continue to adjust and to boost Odyssey performance in the coming quarters. Now, this next chart also highlights the repricing that needs to happen within private real estate, as the spreads between cap rates and the 10-year Treasury have been meaningfully tighter since 2020 than over the last 10, 20, and 30 years. Investors have also been paying high premiums for both multifamily and industrial properties, bidding up prices and keeping cap rates low. But there does remain a substantial amount of dry powder in the sector, and so spreads will likely remain somewhat more compressed than historical averages, as competing capital continues to bid up real estate prices. Now, another theme to touch on over the last few quarters within apartments and industrials has been the abundance of supply and resultant fall in prices. However, as regional banks have pulled back from construction loans and financing new construction has actually become more expensive than purchasing existing properties, starts have plummeted and deliveries are expected to contract. This should result in rent growth for both industrial and multifamily properties in 25 and 26. As mentioned in prior webinars, the debt maturity wall in commercial real estate poses a problem for borrowers from a refinancing perspective, with $1.5 trillion of U.S. commercial real estate debt coming due before the end of 2025. Now, digging further into this theme, we see the substantial number of loans expected to mature over the next 3 years, with loan-to-value ratios of greater than 80%. The plurality of these loans reside within the office sector, but apartments actually also make up a meaningful proportion of the high LTV loans. And the concern here is that there is a much higher probability of default and that the lending pool has shrunk. Now, on the other hand, this has been a benefit for alternative credit financiers. And so we'll go to one last chart here highlighting the potential looming debt problems related to real estate. Regional banks are an important provider of real estate financing, but they have also pulled back from lending due to the health of their balance sheets. This should create opportunities for private real estate investors to step in and provide funding. And so we'll wrap up real estate here on a positive note. The private real estate environment has been quite challenging over the last couple of years, but it's important to remember that investors in the asset class do not need to time the market. This chart here shows the 5-year return of the Odyssey Index after periods of significant contraction. Historical data illustrates that there's typically about a half-year window on either side of the trough, which will deliver comparable returns when zoomed out 5 years. So moving on to the other tangible asset class, infrastructure has continued to provide steady, rock-solid returns through market cycles. If you look at its relationship to CPI plus 5%, private infrastructure continues to be a diversification tool against inflation while generating a reliable income stream. And over the last 5 years, private infrastructure has outperformed the public index with an annualized return of 8.8% compared to the DJB's 3.3%. Now, this chart further underscores private infrastructure's remarkably stable return profile. We can see across 4 different economic scenarios, private infrastructure, which is represented by the purple bars, has been less volatile than both bonds and equities. It will likely underperform in good economic scenarios, but will outperform in bad ones. Next, we'll see how here the growth in private infrastructure AUM has been very steady, as well as the steady uptick in dry powder. Particularly given the backdrop of the energy transition, record amounts of capital are slated to deploy throughout the rest of the decade. And then finally, rather than hit on all these opportunities and risks, I'll just call out the first opportunity, which is the energy transition and emergence of new sectors. Now, to meet energy transition goals, the world will require additional investment in transmission lines, hydrogen production, and renewables and battery storage. Also, particularly within developed countries, modern digital infrastructure is increasingly seen as a public good. So this is an exciting time for infrastructure, as the breadth of opportunities should really only continue to expand throughout the rest of the decade. And I'll pass it back to you, Greg.
Thanks, Michael. And tracing back to real estate from a few minutes ago, again, the biggest headwind there is the office sector and what's going to happen there, and then the associated loans with that sector and how they're refinanced. That bears a lot of watching in the coming quarters. And for infrastructure, Michael, you touched on it again. There are new sectors, especially amongst this energy transition, that should do nothing but increase more interest in the asset class. So now we reached the private markets portion of the webinar. We have private equity and private credit. Amy, you can take it away with private equity.
Thanks, Greg. Let's start with some recap of performance. Just as a reminder to the audience, we are reporting on a lag. These numbers are as of the third quarter of 2023. The bright spot here is global and U.S. private equity had strong performance for the quarter, with buyouts in both of those segments, both geographic segments, outperforming on a relative basis. Conversely to that, venture capital still continues to struggle and had another negative quarter. We view this asset class as highly dependent on the IPO market, which continued to lag relative to what was going on in 2021. We're going to touch on the bright spot there in the next slide. But generally speaking, private equity is still outperforming the public markets on a long-term basis, which is a positive. This is a long-term asset class, so we would expect that. That's with the exception of global expansion stage. In terms of exit activity, referring to my previous comment on venture capital exits and their reliance on the IPO market, in 2021, there was almost $200 billion in IPO exit value, and in 2023, there was only a mere 7.3. That was a 97% correction, quite dramatic by anyone's estimations. However, The U.S. IPO market is actually showing signs of life in 2024 as proceeds in the first quarter exceeded the combination of what we saw in the first quarter of 2022 and 2023 together. We're still seeing a compression within the corporate and sponsor acquisition segments as well since 2021, but to a much lesser degree than the IPO market. And actually, corporate acquisition dollars increased in 2023 by about $6 billion. It's important to note, though, that general partners are bringing their best quality assets to market that are going to transact at a reasonable price, which is keeping market multiples elevated in the buyout space. We'll circle back to that point in just a few slides. So going into 2024, we're seeing buyers and sellers finally coming together on pricing as they settled into this new normal of the interest rate environment. And that, coupled with about $3.2 trillion in unsold assets and $3.9 trillion in dry powder, we expect that should cause an uptick in overall deal activity throughout 2024. And then through 2023, with the exit market stalled, as I mentioned, private equity managers were holding onto their assets for considerably longer than we've seen since 2014. These managers are also getting pressured to exit and create liquidity for their investors. So we're seeing an increase in general partner creativity with GP-led secondary transactions or continuation vehicles. In 2022 and 2023, there was approximately 71 continuation vehicles launched, which represents over a 6 times increase from just 5 years ago, which is a pretty big uptick. Recall my comment earlier that the highest quality assets are transacting through traditional channels, such as the sponsor-to-sponsor or via corporate sales. So limited partners should be diligent when considering a continuation vehicle and the quality of assets that are in them. This is all leading to distributions as a percent of NAV being compressed over the last 2 years. And we see that continue to drop to one of the lowest levels since 2009 to 11.1% of the prior year NAV versus a 29-year average of about 26.4%. The largest driver of this drop was the current state of the IPO market. Further picking on venture capital, we're seeing continued trend in the resetting of valuations, which could present an attractive buying opportunity for general partners that have dry powder and those that are currently in market raising capital. So in 2023, approximately a fifth of all transactions were done at a discount to the previous round, compared to a little over 7% in 2021. So conversely, about 93% of the transactions closed in 2021 were at or above the prior round. So it really should be no surprise that valuations were elevated or even that they had to correct. So what does this all mean from a fundraising perspective? So given those recent corrections in valuations, as well as the dearth of liquidity events, fundraising is certainly going to be impacted. It's bringing us back to near 2015 levels. And I believe this should provide an environment where those with dry powder will be well positioned to take advantage of a less crowded market, more attractive pricing. And this brings us to opportunities and risks across private equity and venture. We have a return to normal in terms of pricing, as I mentioned, creating attractive buying opportunities for those with dry powder. That's on the positive side. But a big risk from my perspective includes the formation of and the increased use of continuation vehicles as a method to provide liquidity for investors. It can create a misalignment of interest between general partners and limited partners. And this is something we'll be watching very closely in 2024, Greg. So on that note of caution, back to you.
Thanks. And to repeat that message, continuation funds are a new trend in the private equity world. And because they're new, they're not particularly well known. And investors need to be aware of the risks and opportunities around just continuation funds. And then to the point about opportunities, small buyouts remaining attractive. Again, that's where we focus a lot of our time and energy on funds. So that's good news for a lot of our clients and investors. Chad, there's a pretty high degree of correlation between private equity and private credit, and private equity needs private credit to exist successfully. So take us through what you're seeing from a performance perspective, as well as what you're going to watch for the rest of the year.
Thanks, Greg. And yeah, I would agree. A number of the themes from private equity markets certainly feed into private credit. So here are a few things that overlap with some of the comments Amy made. But just starting with performance here, and as a reminder, performance is again lagged like private equity data. So this data is updated through Q3. We'll have year-end data in about a week. But in general, we've seen positive performance across private credit. If you look at broad-based private credit, that was up about 5.8% for the first 3 quarters of 2023. There's a number of sub-strategies in there, so a little hard to read between the lines, but we've generally seen consistent performance over longer 1, 3, 5, and 10-year periods. Now, if you look at direct lending, this is one of the primary subsets of the private credit universe. That index posted returns of about 9% over that same 3-quarter period. And we've looked at Q4 estimates. That index had another strong quarter with direct lending up over 12% for the full 2023 calendar year. So really capping off a strong year of performance. Returns have mostly come from interest income, benefiting from elevated SOFR rates, and that's tied to Fed interest rate policy, which we've talked a number of times about on this webcast already. But also losses have been quite low. There are a number of indicators we're watching in regards to that. With higher rates, you have higher debt servicing costs, which could lead to some additional pressure on underlying borrowers, and I'll touch on that in a few slides. Now, if you look at the fundraising landscape and what's transpired over the past few years, we definitely have seen a slowdown in the dollars raised for private credit in 2023. If you compare that to 2021, that's down about 35%. But if you look back further, these levels are more in line with pre-COVID annual fundraising targets or levels of fundraising, indicating a return to normal more than a real slowdown from a higher elevated level in 2021. If you look at the breakdown of capital raised by the underlying sub-segments of private credit, direct lending is still the largest component. We continue to see growth there, but we're also seeing some growth in other areas of private credit, areas like infrastructure debt, special situations, or bridge financing. Those have raised more capital recently in those areas. And broadly speaking, I think it points to just a broadening of private credit opportunities in general and may indicate where there's some more opportunities going forward. But that being said, direct lending still is a core focus, offers attractive yields, downside protection, and we're seeing a number of signs pointing to higher deployment activity, some of which you can see once we go to the next slide here. Now, this next slide is a survey that was done at the end of last year. It covered 178 private credit lenders and asked them what they think the primary drivers of deal flow will be in 2024. First, at the high level, you can see 80% of lenders expect deal activity to pick up in 2024 as compared to 2023, and most of that being tied to sponsor exits and realizations. Amy mentioned this, but LPs are continuing to pressure private equity managers to generate liquidity, and I think that'll continue to go forward and underpin more M&A activity going forward. Now, related to that, we've seen a general theme across private markets, and that's the significant buildup of dry powder that needs to eventually be deployed. So I just think that also will underpin deal flow activity here in 2024 as well. And lastly, we saw a wide divergence in valuations between buyers and sellers. Now that gap has narrowed, and there's generally been better alignment on pricing here in 2024. And I think just as that comes towards more of a rationalization and that gap narrows, I think things will continue to churn and you'll see more deal activity. And in fact, we've actually seen that pick up in terms of loan volumes. This shows a significant increase here in the first quarter, all the way back to levels of early 2021, so a significant pickup there. Interestingly, most of this activity has been done to fund refinancing of existing deals. So whether that being lenders granting extensions or resetting prices as spreads have tightened, or other amendments along the way, most of that has been used in that regard as opposed to new deal activity or new M&A issuance. Now, a significant portion of this was done in the syndicated loan markets, which came roaring back in Q1 of this year. And you can really see that better on this next slide here. And now this just isolates refinancing activity, so issuance that was used to just refinance existing deals. Now, for nearly all of 2023, private direct lenders dominated the market. The syndicated loan market was completely shuttered. That dynamic has all shifted here in Q1, with significant deal volume picking up in the syndicated markets, and again, most of that being used to refinance existing debt. And I think we'll continue to see that going forward here as there's a little more certainty on rates peaking, the macro environment, and things like that. What's also interesting on the next slide is the M&A market. So you take out the refinancing, you look at what has happened with M&A. Again, it's been fairly tepid. We've seen it tick up here a little bit in terms of LBOs that were financed this year, but again, still way off the marks in 2020 and 2021. Now, compare that to the refinancing that I just showed on the prior slide. most of the LBO activity has been funded from private credit markets. And I think that just points to the need for certainty of execution that can be delivered in private credit as opposed to the syndicated markets, which is something that's pretty critical when you're trying to execute a private equity buyout. Now, I did mention at the top of my comments that there are a number of things we're watching in terms of higher interest rates and the impact on borrowers. This just shows interest rate coverage ratios, compares the end of 2020 to Q3 2023, the most recent data we have in this index. What you can see is in 2020, more than 63% of borrowers had a really healthy interest rate coverage, more than 2 times. Fast forward to today, that is kind of shifting, going the opposite direction, with about 62% being somewhere between 1 and 2 times. Still healthy, but again, moving in the wrong direction. If you look at the more stressed situations on the far left-hand side, back in 2020, there were only 3% of borrowers that were sub 1 times interest rate coverage or interest coverage ratio. That number has increased up to 16%. And again, we're watching this. We're not at levels where we're concerned, but it's certainly important to note. Now, again, if interest rates come down from here, at some point, this should go the opposite direction, or at least settle out and stabilize. But certainly something to keep an eye on in terms of stress in the market that could arise. And just finally, I'll wrap up on opportunities and risks. Talked about interest rates a lot. That's led to elevated yields and attractive returns of late, but that also could lead to more defaults in terms of higher debt servicing costs. Again, we've seen increased deal activity. I think that'll continue to persist here in 2024 as opposed to 2023. And then there's just this notion of increased competition. We've seen more and more lenders come into the market. If you look at my inbox, you can see a new manager reaching out every single day to discuss their strategy, their differentiated opportunity set, and their sourcing. The more that continues, you can see spreads tighten further. You can see things like covenants and other forms of downside protection sort of dissipate, and just leads to less downside protection. So it's just something for us to continue to watch and be cautious of. And with that, I will turn it back to you, Greg.
Thanks, Chad. And I think their last point, it really bears repeating that the increased competition, not only from the dynamics it fuels in the market, but also the fact that some of these managers are new to this game and may not know the space particularly well. We want to make sure we're partnering with effective managers who have seen this asset class in a lot of different ways and flavors. So we have about 5 minutes left, a little less than that. I promise you all that this will never go longer than an hour because I know everyone has busy days, but I want to cover some of these questions that have come in advance. So analysts, as I farm these out to you, maybe try to be as concise as possible so we can try to get done within the next 4 minutes. But Amy, back over to you about private equity in the exit environment. What factors could have the biggest impact on the private equity exit environment this year?
Thanks, Greg. There's two factors I think are going to have the biggest impact, and one we've actually seen some movement in, and that's the general partner psychology. And this is certainly harder to estimate and predict because it's human behavior. However, we're seeing seller sentiment continue to point to us settling into a new normal, as I mentioned earlier, in terms of the pricing of assets. Those that have not accepted the fact that pricing has come down slightly are going to be turning towards alternative methods of exits, such as the continuation vehicle or NAV loans. The other aspect would probably be, I would put at the top of the list, is interest rate cuts. I think a single cut would spur a pop in activity. If Catherine is correct, or Greg, maybe it was you that mentioned that the first one isn't expected until later this year. I think that's going to be, maybe make an increase in the latter half of 2024. And then that will help, reduce the cost of capital. And a great deal of buyout activity is going to be dependent on that manager's ability to source debt at attractive pricing, which, if Chad's right, increased competition might add to that as well. And that will help them meet their return expectations.
Thanks. And then staying in the private arena, Chad, does the reemergence of broadly syndicated market activity cause concerns for private credit markets?
Yeah, I think in general, if borrowers can access the syndicated markets, they will certainly try to do so. It's generally a cheaper form of financing. There tends to be less covenants, these covenant-light deals, so less restrictive for borrowers. But that being said, I think having both the syndicated markets and direct lending in general functioning together is healthy for the ecosystem, certainly supportive of private equity and M&A. So I think it's important to have both. There will be some borrowers that prefer the certainty of execution in direct lending markets. So I think you'll always have borrowers that tend to lean one way or the other, but I think it's important that we have both for the ecosystem in general.
Thanks. Michael, some of the niche sectors becoming more popular than real estate.
Yeah, so we've seen a lot of reallocation of capital within real estate. Sectors like manufactured housing, senior and student housing, life sciences, and data centers have all seen meaningful growth over the last few years. This growth is driven by a combination of technology and demographic shifts, and we've seen institutional capital flow into these subsectors, including from Odyssey managers. And maybe one important thing to note is that these subsectors tend to be operationally intensive, so it'll be critical for Odyssey managers to partner with skilled operators in the space as these spaces continue to grow as to be a larger portion of Odyssey composition.
Thank you. All right, we got time for one more. Evan, I'm gonna throw it to you for hedge funds. In terms of new capital deployment, which strategy types are hedge fund investors currently most focused?
So we're seeing an interest in uncorrelated strategy types like equity market neutral, multi-strat, global macro, CTA. But I did want to quickly address one question from the audience that we got. How do we calculate leverage and what are the sources? So gross leverage is the market value of all the longs plus the market value of all the shorts divided by total capital invested. Net leverage is percentage of longs minus percentage of shorts, and that's your directional market exposure, basically your beta. And then the sources on those are the prime brokerages, so the Morgan Stanleys and Barclays of the world. So hopefully that's helpful.
Great. Thank you, Evan. 2-for-1 special, and we're at the top of the hour, and we're pushing to 2:01 Central. I want to get everyone out of here. Thank you all for spending some time with us. We hope it's been a good use of your time, and you walk away with a few things to watch for. Any additional questions, you can email at this address, research5@marquetteassociates.com, and this will be up on our YouTube channel shortly if you'd like to rewatch. Thank you all. Have a great rest of your day. See you next time.